Hi, good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. And before we begin, please confirm in the chat box by typing yes or share an emoticon if you can hear me clearly. Okay, I repeat, if you're able to hear me clearly or see my slides, please type in yes in the chat box so that I know everything is working well on your side as well as on my side. All right, great. Thank you very much. I appreciate that. Now, today's Let's Learn Futures webinar topic is combining price action and indicators, strategies for high probability trades. This LF webinar series is proudly brought to you by Bursa Malaysia in collaboration with Excellent. I'm CY Song. I will be sharing with you about how you can combine price action strategies with technical indicators, okay, so that you can improve your trades with higher probability of winning in the market. So let's get started. All right, I see there are more and more people have just joined the webinar room. Welcome again. Before we begin, let's do one more final sound check for those of you who just came in. Please type in 111 or yes in the chat box if you can hear me clearly. Right? If you can hear me clearly, please type in 111 in the chat box. And also, if needed, please adjust your volume settings to ensure optimal sound quality. All right, great. I can see those of you who responded to me. Now, to ensure you have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will help minimize internet bandwidth usage and also prevent interruptions and ensure an optimal learning experience for everyone. Today's session will be divided into two parts. The first part, I will be presenting my sharing, and following that, we will be having a Q&A session where you can ask any questions related to today's webinar topic. And of course, if you do not know where to find the Q&A box, this is where you can follow. Now, first, so what you need to do is that, somewhere on your lower right on your screen, depending on your device, you need to find there's more options there, and then you can search for a Slido Q&A box, okay, or a little green logo there. So once you click onto it, you can type in your questions in the box so that I am able to capture your question and address it in the Q&A session. All right, and due to high volume for messages in the chat box, it may be challenging for me to spot your questions if you don't use this Slido Q&A. All right, so feel free to type your question in the Slido box at any time during the session. As this is the LLF Let's Learn Futures webinar series brought to you by Bursa Malaysia, we have a lineup of exciting topics ahead to help you deepen your understanding of futures trading. Every Tuesday, we will host a new webinar topic in this series featuring sessions in English, Malay, and Mandarin. Our panel of speakers and experts will share their valuable insights and also knowledge, and most importantly, practical strategies that is related to futures trading. We have many content-packed and informative topics lined up with more which will be added regularly. So if you're interested in enhancing your knowledge and skills in futures trading, simply scan this QR code to register. And also don't forget to add this session to your calendar so you won't miss any of them. Besides that, we also have the Let's Learn Futures, the LLF online workshop. Now, this online workshop is specifically designed for those of you who are new to futures trading. Because in this workshop, we will cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. So each session is 3 hours long. The upcoming LLF online workshop session, it's actually next month. In fact, it's very near. It's just this coming Saturday, which will be conducted in English. Okay, 2nd of August is actually this coming Saturday. So if you are interested in it, want to get it immediately, so please sign up for 2nd of August. And if you're new to futures trading and would like to learn more, okay, please sign up these online workshops because they are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants only, so be sure to grab your seats quickly. Now, my name is Saw Chun Yen. You can just call me CY. I believe some of you who may have joined us in this LRF webinar or online workshop, you may have probably seen me before. Whereas for some of you who are still quite new here and may not be familiarized with me, now just let me make a quick introduction. My education background is in finance and investment, and I started my career in the capital market, specifically involved in trading and investment management. So I have been trading across different multiple time frames, including from very short term intraday scalping to short term trading, then also to long term value investing. So yes, I do specialize in technical analysis. So you can see I'm a chartered market technician, not just only in technical analysis, but also developing trading strategies and systems and trading psychology. And besides that, I'm also involved in hedging and risk management consultation, where I consult with companies to help them hedge and manage their commodities, price risk, and other financial risk. All right, so that's a quick, brief introduction about myself. Now it's about you. All right, it's about combining price action indicators and strategies for high probability trades. Now, before we begin, I would like to get a quick sense of those of you who are here. Now, if you're using price action in your trading, you can type in PA. If you're just only using indicators in your trading, you can share what are the indicators that you use in this chat box, so that I know what kind of indicators that you use, whether you use price action, or for those of you, if you have combination, you can just type in combo. And of course, for some of you, if you might be mixing here and there and you have no clue about what you are doing in trading, you can just type in 0. Okay, so that I know you do experience some difficulties in trading, or even though you have learned a lot of stuff. All right, just so I can see there are some who okay, of course, majority of you who do have experience in trading here, it's just that whether you have little experience or more experience. All right, I see some of you, majority of you using price action. Okay, very good. Some use ADX, Bollinger Band, money flow index, MACD, volume. Okay, combination. Some of you, maybe you're new. Okay, you type in 0, or you use a lot of indicators and you have no clue that what you are doing in trading. Okay, which is why you're typing in 0. All right, so which is why today's topic is very important. It's about price action, and it's also about indicators. Now, traditionally, when we have only price action, when you learn technical analysis, there is only price action, correct? Traditionally speaking. So, of course, as the field of technical analysis has been growing and developing, so this is where indicators come into the picture. And then later on, traders learn how to improve their edge, increasing their probability of trades. They want to have more winning trades, lesser losing trades. So which is why they, try all sorts of things, and also including combining price action and indicators. So today we will be delving in this combination. And of course, for those of you who are still new in trading, if you don't understand these immediately yet, that's fine, because as long as you get more exposure about some of those advanced and even basic trading strategies, you will more or less naturally you will learn what are the things is expected in trading, what is possible in trading, and what are the things that those experienced traders and even professional traders, how do they apply different tools to make their trading decision that makes them consistently profitable over the long run. All right, so let's begin. Before I start, I would like to give a quick disclaimer. Of course, this presentation is intended solely for educational purposes, and it should not be considered as investment advice or recommendation to buy or sell futures contract. Throughout today's webinar, I will be sharing with you some trading strategies, some of the tips or some good practices that I use in my trading. Okay, so if you agree with it, you can type in yes. I'll give me a good review. If you don't agree with it, that's fine. You could just add something new in your toolbox, so that one day, okay, you might find it to be valuable in your trading. Okay, because as traders, we do not want to limit our toolbox. We want to have as many trading strategies, trading systems, so that, in case one day, if one tool doesn't work well, there is still other tools that we can use in terms of, capturing trading opportunities in the market. All right. So with that being said, my hope today for today's session will help you broaden your perspective and also deepen your knowledge on how to make your trading journey sustainable. Now, the topic I will be sharing you about what is price action 101. We go through one by one first, okay? I want to define each and every item clearly so that both of us have both of us we are speaking at the same language, and we also have the same point of view and similar understanding before we go a little bit more advanced. Okay, so we are going to start with price action 101. Then I'm going to share with you what are the key technical indicators for futures trading that is commonly used in the market. Thirdly, then we will combining both price action and indicators. And what is possible here is that we want to look at whether is it possible to have a high probability of trading or not. And of course, lastly, what are the things that you need to have, okay? Because even though you have combining these two tools in your trading, you still need to fulfill some requirement in order to be consistent and building a long-term success in trading. All right, now let's begin with price action 101 first. Now, understanding price action 101. Now, I know that when it comes to learning trading, whether it is from books, YouTube, blog articles, or even you have attended seminar courses, different speakers, different authors might use different terminologies differently. Okay, some of them, even for the same terminologies, they may have a completely different definition and different meaning. Okay, so let's get this and also set this clear. When we talk about price action, we are also talking about understanding the price movement. And we are also talking about understanding the price behavior of whatever things that you're trading. Okay, whether it is futures, FKRI, FCPO, FSOI, or even FGLD. Okay, all of them are the same. Okay, let me repeat: price action, price movement, and price behavior. All of these terminologies or different words, they are actually referring to the same thing. Okay, so let's begin with price action. Now, what is price action? Now, price action refers to, of course, the movement of the whatever product that you trade, the prices over a period of time. We are not just looking at 1 day or 2 days. We are actually looking over time. So, which means this time, it will be all represented in a chart, correct? And all of this, it forms the foundation of technical analysis, as this will reflect in a real-time market sentiment, and also you will also be able to gauge what is the demand supply dynamics in the market. So unlike indicator-based methods, price action trading, okay, whenever you read books, looking at articles, when we talk about price action trading, what it means is that we are focuses solely on naked charts, okay, just like the charts that you look at this price at this light. So which means it's a completely empty chart, whether it is a bar chart, line chart, or even candlestick chart. There is no indicators there. There's completely naked, nothing. It's very clean. So this is what we mean by price action trading. Okay, so we want to look at the price movement without having any overlay, such as moving averages, RSI, MACD, or any other technical indicators. So traders, they will be analyzing patterns. Okay, they will be analyzing candlestick formations, support and resistance levels. They will also be looking at trend structures to make important trading decisions based on what is the price is doing, okay, not what the indicator suggests. So which just means the primary thing that you need to look at is actually price. Now, of course, when we talk about price action, we are talking about price. So there are several assumptions that you need to follow about price. Okay, number one, you need to know, and also this thing, even if you disagree, right, you have to agree it. Price actually reflects everything. Okay, all available information in the market, whether is it financial data, economic data, market sentiment, news, all of them, okay, all of those is what we call as information. All of them has already reflected in the current market price. So if the current market price, let's say, is saying that it's $4,000, $300. So all of them, you need to agree with the price. Why? Because whatever things that traders would want to do, whether they want to buy, they want to sell, they want to clear all of their positions, whether they want to take profit or cut losses, all are already reflected in the price. Okay, so price is actually the ultimate truth. So which means even technical indicators also derive from your price. Okay, technical indicators, although it is mathematically formulated, right? It also uses your price, your opening, high, low, and closing price. Now, second thing about price is that history tend to, of course, repeat itself. So, which is why it makes price action trading very handy. So, market participants, they often react in a similar pattern, okay, to similar price movements. So, these will, of course, it will lead to repeating formations. For example, like double top, head and shoulder. When you look at doji stars, what is expected in the market? When you look at our engulfing patterns, what is your expectation about the next market movements? So all of these price patterns, whether is it using one candle pattern, two candles pattern, 3 days pattern, uh 3 weeks pattern, all of them is what we call as patterns. Okay, these patterns, they reflect a collective of human psychology in the market. So which means when they do buy or when they do sell in the market, it is already reflected in the price. Okay, now number three, of course, when we talk about price, we have something is calling as support and resistance. So these are actually a psychological level where traders often, they place orders around those key levels due to fear, due to greed, or even due to past price behaviors. So all of these levels, they will act as magnets where price is going to likely to have a big reaction there. Okay, and of course, lastly, candlesticks, even bar charts, okay, all of them, they have opening, high and low close price. Okay, all of these, they represent a trader's sentiment. What does a trader believe in the market in that particular day? Okay, so when you combine multiple days, right, it becomes from a daily to 2 days to 3 days to a long term. So this is what we can see that in a chart there are multiple time frames on that. So each candle, they tell a story. Okay, it tells the strength and weakness of the market. They tells whether the bull or the bear is actually strong, whether the bull or bear is actually tired or in the exhaustion already. They also tell whether there is indecision in the market. So when you read charts, you're actually reading about a story. You are interpreting a story. So reading this correctly will allow you to anticipate future price movement. Okay, now here are a few price action concepts that you must know. Okay, so when you have already know price action, so few things that you must know is number one, we have trend structure. So which means what is uptrend, what is downtrend. So for an uptrend, the characteristic for an uptrend is that you will have a higher high and of course higher low. Now this indicates a strong bullish momentum. On the other hand, for a downtrend, the characteristic of a downtrend is that you have lower highs and lower lows. So this will reflect a bearish pressure. And of course, you will have a support and resistance. So support and resistance is actually a horizontal line. Okay, it's a horizontal zone where it actually telling about a specific price level where buying or selling interest tends to happening around that price. And of course, lastly is the market phases. Different market situations, of course, we know we have bear market, we have bull market, we have upward direction, we have downward direction, and also we have a sideways market. So all of these different market conditions, okay, at least these three conditions, up, down, or going sideways. So different market conditions, your price action, even for the same pattern, right, it has a different interpretation. So whenever you want to apply whatever price action patterns, right, you need to know whether it is on top, whether it's at bottom, or whether is it in the middle. Okay, so all when you differentiate these three different trends, then it's clearer on how to do your interpretation. Okay, now one last thing before I go into the important part on price action is actually reading the chart is actually like reading a story. Okay, oftentimes people learn I believe many people learn technical analysis is people just look at uptrend buy, downtrend sell, look at whether there's a signal, looking at whether there's a specific pattern or not. Okay, but in fact that is beginner level. Okay, yes, when you get started in trading, it's you need to learn how to just like a kid, like a baby, right? They learn how to recognize what is 0 to 9. They learn how to recognize alphabets, what is A until Z. Then after that, you need to actually be able to interpret meaningfully. Okay, so in fact, charts are actually more than just numbers or patterns. They are actually telling you a story of the market psychology. They are telling you a story of momentum in the market. They are telling you a story about what is the decision making of those market participants over time. So when you read past data, when you look at reading past history, right, you're actually trying to analyze historical price movements to understand what is the narrative of the market, what is the story of the market, where is the market has been, how is it being reacted, and what are the patterns are forming. Okay, besides that, you also want to know who is actually in control, whether it's the buyer or the bulls in control, or the sellers, the bears are in control. So this will allow you to gauge who is actually dominating based on the trend strength, based on the candlestick behavior, and also based on whatever patterns that you look at. Okay, and of course, lastly, using price action, it will actually allow you to spot fake out and turning points. So of course, when you just only applying indicators alone, it has its own limitations. When you use indicator, you are not able to spot whether there is a false breakout or not. But if you were to combine price action, it actually, you are able to actually improve your probability of winning. Okay, sometimes there will be signals that you can choose to ignore. There are signals that you can choose to skip and not entering the trade. So this allows you to spot fake outs, and also choose a high quality trade. And most importantly, which is the last one, context is everything. Okay, you need to always consider the broader chart structure and also the market phases before acting on any price action. Okay, so a candlestick pattern means very little. Okay, if it is actually it is placed all over the trend. Okay, so for the same candle, when it is being positioned top, middle, and bottom, all of it has different meaning. So you want to find a pattern that is that carries the most meaning for a particular trade. Now, I believe this picture you are able to find it online. There are plenty of it. Okay. Now, one thing that I want to highlight to you is that when you use price action method to analyze the market, oftentimes we are actually looking at the reversal point. Okay, when we look at price action patterns, we are looking at reversal point. We are not so interested in looking at trend continuation. So this reversal point, it can be a single candle by itself, where reversal is on the day itself. We have double candle patterns where you wait until the second trading day. Okay, now after the reversal day, you wait for second trading day to confirm whether there is a valid reversal. Then we improve on it. We can also look at triple candle patterns, whereby here you will be looking at three on the third trading day to double confirm again, okay, whether there is a valid reversal again or not. So you need to identify if there is any shift in trends or even reversal. So a bullish market typically starts with a bullish reversal, okay, from a downtrend to an uptrend. For a bearish market, it often begins with a bearish reversal from uptrend change over to downtrend. So again, when you know about, when you're able to identify all of these patterns, okay, you need to add one more thing, which is your context. Okay, just now I mentioned context matters a lot. Not all reversal patterns are valid in every situation. So key conditions you need to include whether whenever you look at this price action, whether is it happening at a meaningful support and resistance levels or not, whether is it aligned with the broad market structure or even a specific trend phase, whether does it confirm with volume or not, whether does it confirm with any price behaviors. So price action, it's not difficult, while at the same time it is not as simple as just identify uh, candlestick patterns. Okay, now let's have a look at this chart. Okay, now you need to look at conditions first. Okay, the condition for a valid reversal. So here are some of the items that I have already circled in red. So all of it are actually at the U-turn, the reversal point. So you can have a look at this is that some reversal, it is one candle. Some reversal, it takes two candles. Some reversal, it takes three candles as a confirmation that it is really, really reversal. Okay, so before a reversal can occur, there must be a clear existing trend. So what do we mean by that? When you look at reversal pattern, most importantly, okay, you must know that, for example, on hold on a moment, my pointer is a little bit out in place. Now for before a reversal pattern, okay, before the circle, you can see before a circle there is actually a trend. Yeah, whether is it an uptrend or a downtrend. If it is uptrend, before it is an uptrend, so you are looking at a downtrend reversal. Okay, if on the left hand side it is already a downtrend, so the reversal you are looking at, it would definitely be an uptrend reversal. So it is like after 1 it will be 0, after 0 it will be 1. Okay, now this reversal means that market is actually going to shift in direction from uptrend to downtrend, or vice versa. So if a trend has been moving sideways in a range, then that particular candle signal, right, what you will be seeing is actually likely to be a continuation or a breakout. Okay, it is not a reversal. Okay, take note of this. Reversal and continuation or breakout, it is a different thing. So try to look at reversal rather than breakout, because breakout, the interpretation might be a little bit different from that. Okay, so again, when you're looking at sideways, that means there is no trend. So no trend means there is no reversal for you to look at. Okay, if the price is actually flat or choppy, what you need to do is you need to wait for a trend to establish before you are able to trust if there is any valid reversal signals. Okay. Now, of course, one last thing is that you need to enter only when the story makes sense. If you interpret all of those charts, if the candle does not make sense, of course, you can actually skip those particular trade. Before you enter a trade using price action, you need to take a step back. You need to read the chart like a story. For example, ask yourself these questions: whether is this story it's about strength, or whether is it a weakness? Are buyers causing the price to go higher with momentum, or whether is the sellers, the bear is actually dominating the market? Okay, you also need to know who is actually in control. Are the highs going higher and higher, or whether the lows is going lower and lower? Okay, you need to know who is actually in charge, in control of the market, whether is it buyers or sellers, whether is it bull or bear. And of course, the last question you need to ask yourself is that whether is this a breakout whereby price is actually escaping a range or a pattern, or whether is it a pullback, a temporary a retracement within a trend. So this is where you can capture a short-term possible trend reversal, which is a possible entry point for you. And of course, lastly, which is the reversal. Okay, reversal is actually looking at the trend when the trend is weakening, or when there is a possibility of changing direction. So this is the time that we want to look at price action. So let me emphasize on the highlight important point here is that when we look at price action, specifically, we will be looking at reversal. Whether is it a reversal on a short-term trend, you can look at reversal on the medium-term trend. You can also look at reversal at the long-term trend. All of it are fine. And of course, you can use indicators to use it as a confirmation. Why? Because price action actually just telling you a story only. Indicators, they can help support your view, okay, but they should not drive your decisions yet, because your main tool, it is still the chart itself, okay. Indicators, they may be just acting as a supporting actors. So now that I've already shared with you the importance of price action, now let's go into technical indicators. There are hundreds of indicators. Each of them has its own purposes and usage. Because due to time limitation, I'm not going to cover everything. Now, in this topic, I'm going to share with you several key indicators that are popular and practical to use in futures trading. So we will be looking at candle technical indicator alone to make trading decisions. Okay, we just look at indicators alone. We are not combining anything. Now, why do we want to use indicator? Because of course, firstly, it helps us to spot trend easier. We can identify the direction and the strength of the market trend. Okay, whether is it an uptrend or downtrend. Secondly, it can help us to filter out noises, because if you look at price action, the challenge if price action is that we do not know when there will be an up days or down days. All right, so all of these can be, in technical analysis, we call it as noise. It's difficult to identify whether there is up, down, 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 up, down, up, down, or that we can't identify a pattern there. So which is why we want to use indicator as another tool to smooth out or even filter out noises, so that we can able to capture and highlight meaningful patterns. Okay, now of course, when we use indicators, it helps us with fine-tuning our entry and exit timing. When you're able to do that, you are also removing any emotional bias, because if you just use your naked eye to looking at price action, because price action itself, it can be highly subjective. Different people interpret price action, for the same price action, different people will be interpreted very differently. So indicators is actually helping you to remove as much bias as possible. And of course, it helps you to quantify subjective analysis. So when you combine price action, it gives you a confirmation of your price action setups. Okay, it gives you a validation whether your naked chart provide you a correct idea whether is it an uptrend or a downtrend. And besides that, you can filter out those false signals, so that you don't have to get misleading patterns by checking out your indicators first. Okay, so the rule of thumb in trading is that when you slowly advance as a trader, you need to let price action leads first, and then use indicators to confirm. Okay, not control your decisions. Now, when it comes to technical indicators, okay, you can take a picture of this. We have three major categories. I understand that, as I've already mentioned, we have plenty of indicators. Okay, however, you can use these three categories to categorize all of them. We have trend indicators, like moving average. We have momentum indicators. We have also oscillators. Now let's have a look at moving average first. Hold on a moment, my slide is a little lagging. Now, while waiting for my slides to return, now for those of you, any of you use moving average? If you do use in moving average, can you type in yes in the chat box so that I know it is something that you use it quite commonly as well? Okay, for those of you who use in moving average. Sometimes, moving average, it can be called as the mother of all indicators. Okay, all right, I see most of you do use moving average. Very good. Now, of course, moving average, we have different types of moving average. We have simple moving average, we have exponential moving average, we have smooth moving average, we have multiple moving averages, we have GMMA, Guppy, multiple moving averages. So it doesn't really matter which one you use. Okay, the most important thing is that once you get your foundation correctly, once you understand your foundation is strong on moving average, you can, play around with it and have a lot of variety of strategies that can develop out from that. Okay, now, of course, moving average, the common use is for you to use as trend confirmation. It helps you to identify a good support and resistance. Now, traditionally speaking, if you were to draw trend lines, to draw horizontal support and resistance, it can be very difficult. So moving average is something that you don't have to draw it yourself. The line itself is your support and resistance. Okay, it's a very, very objective support and resistance line. So for those of you who do not like to do so much homework in terms of drawing, right, you can use moving average as a tool to help you. Now, of course, moving average is not just only a tool to identify trend direction. You need to be able to develop some rules. Okay, so for example, a simple moving average rule, it is actually good enough for you to identify trend. So for example, for a bullish trend, as long as the price, let's say it's above 50 days moving average or 100 days moving average, then this is indicates as a bullish trend. Okay, as long as price is above your moving average line, it is bullish. If the price is below your 50-day moving average line or 100 days moving average line, the key here is as long as it is below your line, then it indicates a bearish trend. Okay, then you can go a little bit on advance, okay, using two moving averages line. So we have golden cross and death cross. But for those of who are new here, I strongly encourage you to just use start with just one line, because oftentimes I notice is that especially for those who when they learn technical analysis, right, they learn too many things. So when they learn a lot of things, that's good. But when it comes to application, okay, where people apply two moving averages, then I noticed that they have a very, very basic execution error. Why? Because whenever they identify golden cross or even death cross, right, they identify it incorrectly. So of course, if you want to be really competent with moving average, you can start with only one moving average, because this can act as your support and resistance. Okay, dynamic support and also dynamic resistance during uptrends and downtrends. Now this is a typical how does moving average look like. It's just only one single line. So as long as price is above the line, it is an uptrend. Price below your moving average line, then it is a downtrend. So you can see when you apply this, okay, differentiate uptrend and downtrend, this is the first thing that you can do. Then only you apply your price action. So if it is an uptrend, all you need to look at is actually finding a reversal for an uptrend. If it is a downtrend, you need to find a reversal for a downtrend, which is you need to look for bullish signals. Okay, as simple as that. So similarly, when you apply two moving averages, if it is an uptrend, you need to look at the reversal for an uptrend, which means from uptrend turning over into a downtrend. Okay, vice versa. Okay, this is also another moving average in another different trading product, which is your FKLI. Now I want to move on to an important one so that you can get the most value out of this. I believe moving average is very simple, but don't let the word simple fool you off, okay? Although it is called simple moving average, when it comes to application, it is not simple at all. And don't underestimate because of its simplicity. All right, my slide is a little bit hang again. Please be patient with me a little moment. Let me close more application here. Now, next thing, which is moving average convergence and divergence. Now, here you can see again, we can see another word, MA. So MACD, of course, it derives from MA. Now, important thing here, okay, few things that you can look at for MACD. In MACD, we have few things. We have two lines. We have histogram, and we also have the zero line, okay, above zero or below zero. Now, I want to highlight two important strategies that you can use here, okay? These two strategies that I have already highlighted in turquoise, which is your MACD crossover and also your zero line crossover. So MACD crossover, very simple. It's like it's like two moving average line. Okay, when you have your fast line is above your slow line, then it is considered as your bullish line. And when your MACD line crosses below your signal line, then this is what we call as a bearish. And also your zero line. Now, many people uh, focus on the first strategy, which is your move MACD crossover, but they ignore or they probably haven't learned what is called the zero line crossover. Now, this second strategy, zero line crossover, is actually a very powerful strategy. How you can apply, very simple. As long as your MACD line it's above your zero line, it means it is an upward momentum. If your MACD is below zero, meaning it is a downward momentum. Okay, very simple. So meaning it's like the zero line can act as like your sea surface level. If it is above your water, means it is going to go up. If it is below your water, meaning it is going to sink down. All right, and of course we have also third strategy of application of MACD. However, the third strategy, divergence, it's a little bit difficult to interpret. So I would like to emphasize on the first two strategy. These two is good enough. All right. Now, here's a quick sample and example here, how we can look at this. Okay, so you can see that on the MACD, we have two lines, depending on how you want to label. So if there is a clear difference whereby your line, it's, how to say, uh, above, the line that is above your blue color line is above your orange line, meaning it's your MACD above your signal line. So this means, again, the application is like your two moving averages. It means it is an uptrend. If it crosses down, it means it is a downtrend. So the first first strategy, it is relatively quite easy to apply. Whereas for the second strategy, it can be a little difficult. Hold on a moment. I think I need to restart my slide. Okay, please give me a few seconds. Let me restart my slide here. Okay, so you can see at this phase, whenever, how to apply your zero line. Very simple. As long as these two lines, it is above the zero line. And it's very clear, we can see it is an uptrend. Okay, now next, when the MACD line is above your zero line, it is very clear it's an uptrend. Otherwise, the rest of the time when it is below your zero line, it is clearly a downtrend. Okay, despite whether there is any MACD crossover or not. Okay, so very important, you can take a note down. When your MACD line it's above your zero line, it means it is an uptrend. MACD below your zero line, it indicates a downtrend. All right, so this is actually for FCPO. How about for FKLI? Same thing, same rule applies as well. Now, as long as on the left hand side, you can see the MACD line, in fact, both lines are above zero line. So above zero line means it is an uptrend. Okay, the general market is an uptrend. So what you can do is actually, take opportunity to take that has an uptrend bias, which means you can take a long position, or it shows you an opportunity to buy. Similarly, you can see another examples, the second one, which is again your MACD line, it's above zero level, means it is an uptrend. Now, of course, for this second highlighted green area, are you able to see that the two peak of this MACD, the second peak is actually lower than the first peak? Okay, so this is actually what we call as a divergence. Okay, you can see here, this is a divergence, even though the price is actually having the same height. Okay, this is a divergence. So of course, sometimes for divergence, it can be take very long time in order for it to become a downtrend. So very important thing is that divergence, sometimes I do apply it, but most of the time I look at it, but I don't apply it. Okay, the more powerful technique that I will be using most of the time is actually looking at zero level. Why? Because it gives you a clear indication that whether, okay, most of it, the market, whether is it a bull market or whether is it a bear market. All right. So subsequently, you can see as long as the MACD line is below zero level, it means it is a downtrend already. Okay. So subsequently, again, you can see MACD line below zero level, it is a downtrend. Very clear. Now the next indicator, which is your relative strength index. In other words, we call it as RSI. So in this chart, you can see it is not RSI is actually not plotted in your chart. It is actually below your chart. So it is just only in one line. Okay, and of course there are few levels that is very important. We RSI, because it is an oscillator category. So oscillator means is that your line will actually oscillate within a range, okay, from between 0 to 100%. Okay, it will not be more than 100%. It will also not be more than 0%. So in between, the middle line would be 50%. So of course we have two key important levels, which is 70%, we call it as overbought, 30% is oversold level. So you can see if your RSI is above 70, it is considered as, you know, the market is overheated already. Okay, it's like your balloon has already raised up to the sky too far already, which means it is going to burst very soon. Okay, similarly for oversold as well, when your ball is underwater for very long, right? So which means the stronger the ball goes underwater, right, the stronger that it is likely to bounce back up. Okay, so for RSI, there are a few things that you can do. Here there are a few strategies. Now, number one is that you can look at overbought and oversold level, okay, which is if it is above 70, then you can take a potential sell signal there, because why? The market is actually overbought, it is overheated. Whereas if the market is below, the RSI is below 30%, meaning it is an oversold level, so which means too cold already. So which means there will be potential buying signal that you can take advantage on. And of course, most importantly, which is the 50 level rule. Okay, so how you apply this 50 level rule is the same as the MACD zero level. So 50 is actually the middle line is actually your reference line. How you're going to use it is that RSI is above your 50, meaning it is a bullish momentum. RSI below 50, it would be your bearish momentum. RSI, don't use this. Okay, it's another strategy. However, when it comes to application, it can be very complex. You just use the 50 level or the 70-30 would be good enough. Now, here's an example. You can see here is that when the price, okay, on the left hand side, when your RSI is above 50 level, then it is considered as an uptrend. The second highlighted area, RSI above 50 level, it is an uptrend. RSI above 50 is an uptrend. The red zone that I highlighted, RSI below 50, okay, you can see once it started to crosses below 50, it means it is a potential downtrend already. Okay, if it stays even longer, it will be even better, which means the downtrend is going to be a little bit longer until when your RSI crosses up again to 50. Okay, it means it will be an uptrend. Okay, now here is one tip that I would like to share with you. Now, most people use the default, which is the overbought 70%, oversold 70%, or maybe they make some adjustment to make the overbought oversold level a little bit wider, which is 80% and 20%. However, okay, for those who are more advanced in technical analysis user, you can also adjust it to make it your overbought oversold a little bit narrower. So what you can do is that you add another, you instead of using 70-30, you can adjust this 70-30 70-30 to overbought 60%, oversold 40%. Okay, so all you need to do is focusing on this red line only. So whenever your price is above your red line, it means the market is heated. If you have long position, it will be good. Continue to hold your long position until your RSI crosses down your overbought level. Okay, similarly, when the price is below your oversold, 40, you can actually hold your short position, hold it until RSI crosses up 40 level only. Okay, so this of course this minor adjustment can make better sense instead of using the traditional 70-30 level. All right. Now, another example on FKLI, same thing. RSI above 50, level 50 means it is an uptrend. RSI above 50, it is an uptrend. RSI below 50, it will be downtrend most of the time. So you can see indicators, sometimes they tell you a different story from your price action itself. All right, so later on we are going to combine a little bit indicator with price action so that you're able to see how you can improve this for a higher probability trade. Now, why, even though despite using indicators, some traders, in fact many traders, still fail? There are for several reasons. Now, number one is that if you just only look at indicators but you don't look at the context, of course, it means you don't have a full picture. Second reason of failure is that people use too many indicators, so you are overloaded. So too many indicators, it might give you conflicting signal, and ultimately it leads to analysis paralysis. You do not know what decision that you need to make. Thirdly, of course, if you use indicators in isolation and you ignore the chart context, you ignore trend direction or any other important information, so which means you don't have an overall picture. And people also misapply indicators across all market conditions. So it's like you need to understand that some indicators, they work best for a trending direction. Some indicators, they works very well in a sideways directions. Okay, so if you apply the wrong tool in the wrong context, of course it will result in a poor entries and poor exits. Okay, so which is why when you combine things together, you need to make sure both of these things, it actually helps you in terms of giving you more harm. And of course, lastly, people keep changing indicators. So if you keep changing indicators without even mastering one, so it's like you keep changing your tools too often until that you do not know which one to. You are not able to know what is the pros and cons. So it's just like you haven't developed a good relationship with the indicator yet. Okay, it's just like human. You need to spend a very long time with an indicator first, then only you can understand the pattern of the indicator. Correct? Whether does it work well, whether does it not work well with an indicator. You need to understand the characteristic, the personality for your indicator in different market conditions. Now, of course, if you look at these two pictures, on the left hand side, it's like an airplane, very few indicators. On the right hand side, it's also an airplane. But of course, if you are more professional, your airplane will look like this. You have more indicators. Now, one thing that I want to highlight to you is that indicators itself, they don't fly the plane. Okay, you are the pilot, you fly the plane. Okay, so indicators, they are just only an instrument or a tool for you to make your decisions. Okay, even experienced pilots, okay, for an experienced traders, they use indicators to support their decision making. Okay, they use indicators to confirm what they see, for example, out of the window. So besides, if you are flying a plane, besides looking at your indicator, you still need to look out from your window, right, to see your direction is correct or not, whether there is any other things outside other than your indicator. So which is why price action and indicator, these two things have to work in tandem together. All right, another thing on indicators, okay, which I want to highlight to you is the indicators, they are just only maps, they are not destination. Why? Because they show you the terrains. Okay, where are you at? Where is the market doing? Whether is it at what level? Is it high? Is it low? What is the condition of the market? Again, it is up to you as a trader how you are going to interpret it, and most importantly, interpret it based on the context. Okay, now next, combining price action and indicators. Let's have a look. Now, of course, you need to choose what actually really works. Now, of course, in trading, if you just only use price action to trade, yes, there are people who makes money out from it. only price action. Why? Because they really master price action. Are there people who trade only with technical indicators, they make money? Yes, we do have this group of traders as well. Okay, they just only use indicators. They do make money. Why? Because they do a lot of back testing with their indicators. Or in other words, a new form of trading is what we call as quantitative trading. They do a lot of back testing in their indicators. They optimize their use of their parameters of the indicators, and then they can still make money by just only using indicators. How about combination? Of course, combination, you can do it, provided, okay, you must make sure that both price action and technical indicators, they move hand in hand. Okay, both of them has to agree with each other rather than conflicting with each other. Now, why you want to combine both? Number one, of course, price action just only tells you the story, but indicators, they give you a second level of confirmation. When you combine this together, okay, it creates a more well-rounded, a higher probability of approach towards your trading. And besides that, you are able to filter out false signal, because price action itself, sometimes it does really gives you false signals. Okay, the market can be very volatile, the market can be very choppy. So which is why how you can improve your trade is that using price action, you need to filter it out. How do you filter out? Use indicators. Okay, filter out lousy trades. Only keep those good quality trades. So which means you have let's say a list of price action trading strategies. Okay, now you need to filter out what is a good quality ones and which are the bad quality ones. So the bad quality trades, even though there's signal, you can skip those trades or choose not to trade at all. You just only take a position when you are very confident with the trade, when those trade over time again, time and time again, it gives you a high probability of winning, or it gives you a good quality of trade. Okay, so which is why when you add both things, it gives you even increasing your confidence in terms of trading in the market. All right, now a smarter trading is not about choosing between price action or indicators. In fact, you need to use both in harmony. So here this is a quick framework of how you can use it. You can take a quick picture first. Later on, I'm going to explain to you how you can going through this process, which one to look first, which one to look second, and what are the patterns or confirmation that you want to look at. Okay, please take a quick picture of this. Okay, and do use this as a guidance on how you are going to combine in applying in your trading. So firstly, you need to identify what is the trend of the market. So as I've already mentioned, moving average is the easiest and simplest thing to identify. Okay, whether price is up above your moving average line or below your moving average line. Now second, you need to look for whether if there are any key support and resistance levels or not. Okay, which means if you have moving average, you have already done the first level. Second step is that you look on the left hand side of your chart whether there are any key support and resistance level. Okay, then you make a decision. But before that, you also need to wait for any price action signal. Okay, which means it can be one candle, it can be two candle, or it can be three candle patterns. After that, once you identify there is a pattern already, right? You still need to confirm with your indicators, okay, whether is it RSI, MACD, or any other indicators. Then you need to define whether you are going to enter the market. You need to set your stop loss if you enter, and also you need to know how you are going to get out of that particular trade. Okay, what are the things that you need to see? What are the indicators that makes a confirmation that the price has already reverses for you to exit the trade? Okay, now let's have a look at the first example. Now, the first example, it's an uptrend example. So let's, here we already gotten a moving average, correct? So you already know how to identify uptrend or downtrend. So let's say we have a moving average strategy. Okay, we do a pullback strategy. So whenever price pulls back to your moving 20 days moving average line, then we want to find an opportunity to take a trade. So next, whenever you can see, when price comes back down to your moving average, right, you can actually take, for example here, okay, price goes up to your moving average already, and then it comes back down. Okay, this is what we call as the pullback trade. Again, for example here, price already goes back up, your moving average is already far away, you do not want to chase. So the next opportunity is when you wait for the price comes down to moving average, see whether it has potential to bounce back up or not. Okay, so now first thing you have already done. Second, you need to identify whether there is any bullish bar or bullish pattern or not. Okay, so whenever price moves want to reverses, so again you can download a list of resources from Google to see, okay, whether does it fit this, is it this one candle reversal, is it two candle reversal, is it three candles reversal. Okay, if it is an uptrend, please find a bullish reversal. If it is a downtrend, you need to find a bearish reversal pattern. Okay, after that you need to go for another round, which means you need to find whether if there is a confirmation. Now, if you look at this, okay, if we were to go down here, you can see that price, yes, is already above moving average. We want to look at the pattern of the candlestick, and also lastly, we want to look at your other indicator, whether your MACD shows you an uptrend or not. You can see if all actually says the same thing, then it gives you a second layer or even third layer of confirmation. Okay, so now you can see, okay, MACD is also shows it's above zero line, then it gives you a confirmation already. So which means there is a good valid signal, then you can take, to continue with the trend, which is take a long position. All right. So next would be another example that I can show you would be this trade. Okay, this particular trade and also this trade. So here you can see there is a candle reversal. This is also another candle reversal, but you are not quite sure whether it is a confirmed downtrend or not. So what you can do here is that you can see the price structure. The high is getting lower and lower, and the next thing that you want to confirm is looking your indicator, right? Which is, it can be RSI or MACD. So here we are using MACD. It's already below your zero line. So below zero line means it is a confirmed downtrend already. Okay, so even though there is no MACD line crosses, right? Which means two MACD line crosses, it is still fine, because why? It already gives you a second level of confirmation that it is a downtrend. Okay. Now another example here, which is on also for FCPO example. Here we are using RSI as an example, using a bullish candle. Now for bullish, sorry, not bullish, bearish candle. So for bearish candle, so first few things, what we want to do is that we want to look at a confirmation candle. Okay, here we want to look at whether there is a bullish weakening or not. So criteria for using reversal pattern is that you need to know, let's say if there is already an uptrend for a very long time. So the next thing that you need to do is actually to find a bearish pattern, okay, or the bull weakening pattern, and then you confirm with an indicator. So for example, on this particular trade here, although it might not be a one candle, but this is actually confirmed a two candles bearish confirmation. Okay, price action bearish confirmation, and we move down. Okay, it is very far from your moving average line, so yes, it may possibly signal you that the trend is weakening. And of course, if you move down again, moving down vertically, hold on, my mouse is already, my slide is a little bit hanging. On the same level, draw a straight line vertical down. You can see that RSI is actually above 80. Okay, it's also above 70 line. So it means the market is already confirmed very overheated. So what you need to do here is that you can choose not to take a long position anymore. Why? The market is already overheated. So the chances for you to take a long position, or the chances for the trend to continue to go up, is actually low. So what you need to do is, if a low chances for it to continue uptrend, which means it can be a high chances of a downtrend. Okay, because now you are trading futures, you need to be a little bit flexible in terms of moving both directions. A weak bull means the bear can be stronger. A weaker bear means the bull is coming in. Okay, so it's like a tug of war. So again, when you trade futures, you need to be a little bit flexible. It's different from trading stocks, because futures, again, you need to understand that you can trade both directions and profit from both uptrend and also downtrend. So here, a few things that I want to show you is that, of course, in terms of trade execution, you need to find your confirmation. So an exit of an uptrend, it is also an entry for a downtrend. Okay, an exit of a downtrend, it is also an entry for your uptrend. So futures is actually very, very unique. Now you can take a picture here, how you can use a trading setup as a checklist. Now these are the things that I've already showed you just now through an example. Now additional thing that you can look at is that you can look at the risk and reward ratio as well. Whether is this particular trade favorable to you or not. Whether does it fulfill your risk to reward ratio. And of course, when you use indicators, always try to backtest and backtest. Even if you use price action trading, or if you want to do combination, please backtest all of your trading setup. Now, what do we mean by backtesting is that you need to look at the past 3 to 5 years, run the same strategy, okay, and then to look at what is the performance. Record all your profit and loss, and when you have all those data, you can know whether what is the probability of winning after, let's say, after 100 trades. What is the probability of winning? What is the probability of losing? And through these 100 trades, you also know what is the average of amount of winning and losing. Now, today I have just only shared with you the high probability of trading only, right? So which means here it just only fulfill one specific criteria of your trading, which is your win rate and your lose rate. Okay, in order to be really consistently profitable in trading, is that you must make sure your whole trading strategy or your trading system, you need to have a trading edge. Now, trading edge means besides knowing your probability of winning and losing, you also need to know that for each trade, what is your average winning and average of losing. Having a high probability trade does not necessarily mean that you are going to make a lot of money. Okay, it can be having high probability of winning, but each and every time that you make money, right, it is actually very small amount of money. But even though with a low probability of losing, but each and every time when you lose, right, you lose a very huge amount. So this means that your trading edge is actually very, very low. In fact, it's a negative edge. So this is a trading strategy that we do not want. We want to look at a high probability of winning, while at the same time also have a good amount in terms of dollar. The average winning in terms of dollar is also high. Okay, so overall, when it comes to trading, there is a trade-off between your probability of winning and losing versus your average win and lose. So for usually for a high winning rate, your average winning would be low. If for a low probability of winning, let's say 40% to 50% winning rate, usually your average winning can be very, very high. So let's take, for example, for a trend following strategies, like using moving average as a guidance for as a trend following strategies. Your win rate can be somewhere around 35% to 50% only, but your average winning in terms of dollar can be very high, because for a trend following or trend trading strategy, your losing rate is usually above 50%. But if you have a very good risk management structure, you can lower down your average losses, which means you need to have your stop loss, you need to cut your losses short, so that your whole trading has a good edge. All right. Now, lastly, before we end this section, it's how to build consistency and a long-term success. Now, moving on, these few slides, please, if you have a phone along with you, please take a picture as well. Now, a few things that you must know is that, of course, even with trading, combining strategies, yes, most traders still fail is because you don't understand your trading tools and your trading strategy well. So first thing you need to solve this issue is that you need to understand your indicators very well. You need to have a thorough study on your price action strategies. Understand why a particular price action is considered as a bullish reversal. Why is, let's say, a doji star, it's a potential downtrend or uptrend reversal. So you need to have a thorough study, not just looking at not just identify or recognizing the patterns and just follow blindly. Okay, so number one, you need to have a thorough understanding. Number two, as I've already mentioned, price action and indicators, they are just tools only. You need to have your own SOP in trading. So which means you need to build a really clear standard operating procedure. Why? Because if the way of how you trade is not standardized, right? If the things that you do is not consistent, if your process is not consistent, then of course your result will not be consistent. Am I right? So it's very important for you to build your SOP. After you have the SOP, you need to have a discipline to stick to your trading. If you don't have discipline, it's equivalent to not having a good SOP as well. Okay, and of course, emotional trading. Yes, as long as you're trading, investing, it involves with money. Money involves emotion. So I understand that there might be a lot of greed, fear, revenge trading because you want to, make quick money, recover your losses and those things, right? But trading, it's a game whereby you need to stick to your process very closely. Okay, and please do not keep changing strategy too frequently because, as I've already mentioned, if you keep changing your strategy, keep changing your indicators, you haven't developed a good relationship with them yet. Okay, so which means you don't understand their personality, you don't understand when they do perform well, you don't understand when do they perform poorly. Okay, so stick with your trading strategy long enough, then you understand their, how to say, their patterns, their personality. Now, here are a few things on elements of effective trading plan. And these are the few elements that you must have. Of course, number one, you need to have a clear entry and exit rule. Then you need to manage your risk management. Now, as I've already mentioned, even though you know where to enter, where you exit, that is just your probability of winning and probability of losing only. You must have a good risk management in order to minimize your losses, minimize the amount that you lose, even though your trading strategy have a high probability of losing. As long as you limit your losses to the minimal, your trading strategy or your trading system overall can still be profitable as well. Okay, and money management very important in futures trading. Why? Because you are trading with margin. Okay, you need to fulfill initial margin requirement. So for those of you, if you are still new in futures trading, I strongly encourage you to attend this LLF online workshop because you need to understand how does this margin requirement work. And of course, lastly, you need to keep, after you trade, you need to journal it down, you need to review your trade. If you do not record any of your trades, right, there is nothing for you to improve on it. Okay, it doesn't really matter how bad your writing is. Okay, as long as you record it down, then there is chance for you to review it. If you don't write it down, there is no chance that you can even edit your strategy or edit your system. Okay. Now, of course, lastly, you can take a picture of this. Of course, there are criteria for you to be succeeding in this high probability trade. Is that number one, you need to be proficient in develop proficiency in technical analysis. You need to master technical analysis, or you need to master technical indicators first. If you want to combine, yes, you need to combine both, but you need to give yourself time and be patient in your learning. Okay, because when you want to combine both means you need to get the best of two worlds, meaning it takes time for you to develop this proficiency. Okay, you cannot just speed it up and that fast. Okay, if you want to speed it up means you need to do more homework, you need to do more pack testing. Okay, that is the only way that I can think of. Okay, next step number two is that you need to develop trading strategies that work. Then you need to back test it so that you know whether your trading strategies work or doesn't work. Of course, after your back testing, you need to start small first. Okay, never ever start with too big money because you haven't gotten uh, test it in real market yet. So you want to start with small money, understand how does it actually works, how does it impact your overall trading, and of course, lastly, you need to constantly revise and improve on it. Okay, and of course, lastly, you need to develop this mindset for survival. Treat your trading as like your business, because trading you need to treat it really, really seriously. And trading, it's a process-oriented activity. You need to focus on the process, not the results. And of course, the results, yes, there will be losses. You need to learn from your losses. Accept losses as part of your drawdown, because as long as you enter the arena of investing and trading, losses is something that is unavoidable, inevitable. Okay, so what matters is that you need to extract the lessons from your losses, learn from them, and improve on it. Okay, of course, one more thing before I end here is that whether you are a new beginner trader, or even for those of you if you are very experienced already, always in trading you need to survive first and make money later. Okay, if you can't survive first by cutting losses, uh meaning you will be looking at your portfolio getting money keep shrinking, right? So oftentimes capital preservation, it's very important before profit seeking. Okay, your number one asset is actually your capital. If you lose your assets, if you keep losing money in your trading account, right, without it, you can't even participate when there is a bull or bear market. Okay, so capital preservation, it's number one thing. Okay, so of course, again, success in trading is not just a one big bang, one home run of winning. Okay, you need to make sure that you are able to survive. You need to stay long enough the game so that your trading strategy has an edge to work over the time. Okay, so survival is always a foundation, and only those who manage the risk well will be able to see consistent results or return from your trading. All right, so that's it for my sharing. Now, before we enter to our Q&A session, if you have any question related to today's webinar topic, please type in your question in Slido box so that I can pick that up and address them in the Q&A session. While waiting for questions to come in, I would like to ask a small favor from all of you. Please take a minute to take your phone to scan this QR code or click on the feedback form link in the chat box. Please take a minute to fill out this feedback form. Since we have provided an informative session for today, it will take you less than a minute to complete it, and you can find the link in your chat box here or scan this QR code. Your feedback is incredibly important to us because this helps us to improve future sessions and also ensure to continue deliver high quality content for your learning needs. So please take a quick minute to fill out this form, and we will begin with the Q&A shortly. Another 30 seconds to go. All right, a minute has passed. If you have already submitted your feedback, thank you very much. If you're still completing it, feel free to take time to continue. Now let's move on to the Q&A session. I see there are plenty of questions here in my Slido box. And to ensure we cover as much ground as possible, I will select the most relevant questions from Slido and also to rephrase them for clarity. And of course, please understand that due to time constraints, we may not be able to address all questions. Now let's have a look the first question here. Now, what are the settings for MACD and RSI do I use? Now, for me, I would prefer to use it's just personal preference, okay? The MACD and RSI that I use is that I use the default version, the default settings or the default parameter. So which means I don't change the parameters in my MACD or RSI here. Now, the reason that I do not want to change anything here is because it is the setting is set as a default for a particular reason, okay? Because irregardless of which charting platform that you use, you will almost notice that the default parameter settings will be almost all of them would be roughly the same, okay? Why? Is because I do not know why. Okay, probably it's because the developer of the indicators, they have already done a lot of testing, so it is widely recognized by internationally, and it has been tested many times. So which is why they put that as a default settings. The second reason that why I use default is because I would also want to know what is the general markets participant is doing. Okay, because generally speaking, most market participants who are not so proficient in technical analysis, they will not make any changes in their parameters. Okay, so they will also use the default version. So when you use the default version, you will also more or less know generally what are other market participants interpret the current market conditions. Okay, so which is why the settings, I would maintain it as a default setting. Now, next question. Okay, I see there's one participant who would like to know what is my opinion about prick and trial analysis, and whether indicators are self-fulfilling prophecies, having more noise than signal. Now, for prick and trial analysis is actually one of the good thing to do in your trading. However, you need to know what kind of trial and analysis, peak and trial analysis that you would want to do. What kind of time frame? Are you looking at short-term time frame, medium-term time frame, or long-term time frame? Because we have short-term trend, medium-term trend, and long-term trend. So if you are doing short-term trading, then definitely you would want to look at a short-term peak and trial analysis. Okay, if you're doing long-term trading, then you need to look at the longer-term peak and trial analysis. Now, secondly, is whether indicators are merely self-fulfilling prophecies. The answer, it would be yes and no. Now, of course, for those of you who read articles or technical analysis book, right? Of course, they would say that technical analysis is self-fulfilling prophecies. Why? Because every other people is also using technical analysis. So, for example, when you see that price is actually reaching near resistance level, and once it breaks out, then price will continue to go up. So yes, it might be a self-fulfilling prophecy, because once you break up, most people would also expect it to break out, right? So they enter a particular trade. So which is why in technical analysis, you need to treat it always as a tool only. You need to still identify and really read the story. Okay, not many people use technical analysis as a form of story reading, because charts, most people look at charts as they just look at buy and sell signals. But if you want to improve on that, okay, for a very proficient or masterful in technical analysis, you need to read the story of the market. What does each and every candle, what does the combination of price action and indicators is trying to tell you at that particular moment in time, so that you are able to make a meaningful trade. Okay, so tools are just tools. Analysis is just analysis. You still need to develop trading strategies on your side, because you need to filter out as I've already mentioned, you need to filter out poor quality trades and keep those good quality trades. Okay. Now, next participant, can combining price action and indicators be used in short-term time frame or not, such as 1 minute or 5 minute chart? The answer is yes, but of course, the shorter the time frame when you try to do combination, right, your decision making would need to be a little bit way faster. Okay, so for those of you, if we are still very new in terms of using do combination, right, I would suggest you to use a little bit longer time frame, for example, hourly time frame or day time frame. Why? Because hourly chart, if you use 1 minute of 1 minute chart, right, each and every minute you need to do your interpretation. So the speed can be too fast already. So which is why if you're able to stretch the time frame to be a little bit longer, try to, uh, develop your strategies that is go on longer time frame, then price action and indicator would make a little bit sense. And of course, when we look at price action, sometimes let's say 1 minute time frame or 5 minute time frame, the price action may not be valid. Why? Because sometimes those big traders or institution traders, they might want to execute a particular trade, right? So they may have a big and huge order that is entering the market. So this may generally influence the short term price movements. It may have nothing to do with price action at all. Okay, it is just it happens that at a particular point in time, there are a huge trader or an institutional trader is entering or exiting the market. So which is why sometimes that particular price action may not be meaningful for interpretation. So which is why sometimes when doing price action trading, it would be good to use a slightly longer time frame. Okay, another question. Can I share more about how to do backtesting? Okay, just now I have a slide on backtesting. Now, number one, why do we mean by backtesting is, of course, is that number one, before you do backtesting, you need to have a clear, defined trading strategies. You need to know how are you going to enter, what are the things that you need to look at to enter and exit the market. Okay, your trading strategies must be there first. Now, the next thing is that you need to take this trading strategy to look in the past, okay, let's say for the past 3 years or for the past 5 years, using the same strategy to trade, to see each and every day for your trading. When there's entry, you just enter the market, write it down, what is the date, what is the price, at what level. When you have an exit signal, you just exit, what is the date, what is the price. So when there's a date and there's a price, right, so you are able to find whether that trade is a profitable trade or losing trade. So across 3 to 5 years, you can have a series of trades already, a number of trades. Let's say 100 trades. So 100 trades would be a more meaningful judgment of whether your trading strategy is profitable over the long run. If you're just using 5 trades, it's not meaningful. Why? It can be a five consecutive losing trades. So which is why when it comes to backtesting, we want to look at the more trading sample for applying that trading strategy, the better. Okay, so when you can see that, gather all this data, all the performance of your trading strategy, then you can find out, okay, this trading, out of 100 trades, what is the probability of winning? Probability of winning means even though it makes $1 or makes, as long as it makes money, okay, no matter how big or how small money, as long as it is winning trade, you put it as a probability of winning. If even it loses $1, you classify as a losing trade. Besides that, in backtesting, you have all your performance already, right? So you need to calculate what is the average winning and average losing in terms of dollar, okay? Because you do want to make sure that besides knowing your probability of winning and losing, you also want to know that when you win, on average, how much dollar that you win. When you lose, how much dollar that you lose, so that you are able to find out what is your trading edge. Okay, so this is how we generally would be doing a back testing. Now, next question, are there any good rules or guidelines to choose which technical indicators to use. Of course, for starters, please use the most popular technical indicators. Okay, for example, we have three categories, right? We have trend indicators, you have moving average, you have Bollinger Bands, you have moving average channel, you have Donjon channel, you have fractals, anything that it's the indicators directly on your price, stick on your price itself. That is what we call as the trend indicator. The other category would be momentum indicator, something that is below your price. So MACD, I believe it's good enough. Okay, or you can use momentum indicator itself. And the last category that you would want to use would be an oscillator. So if oscillator means, again, it's an indicator that it's at the bottom of a chart. So how do you know if an indicator is considered as oscillator or not? Usually oscillator would be the value there, okay, would be from 0 to 100. Okay, this is what we call as oscillator. So you can use RSI, or you can use, let's say, William percentage R. So these are the few popular oscillator that you can use to use in your trading. So any good rules to use any of them is that there is no fixed good rule to use, as long as you know use the popular one, okay, rather than using those odd indicators, because some odd indicators, it may not be well developed, it may not be well researched. So use the popular one, because almost everyone in the market participant also use the similar indicators. Okay, of course, the criteria here is that you need to be really proficient in terms of using and interpreting them. All right, I see due to time limitation, I'm going to cover one or two questions. Now, what is the best time frame to use the combination of this strategy is, of course, a slightly longer time frame would be better. Why? Because if you use too short time frame, like 1 minute, 5 minutes, it might be giving you a distorted picture. Although even 1 minute, you can still use combination. However, the longer the time frame, the better the validity for your signals and confirmation. Okay, and another one would be if you are still I'm still new to trading, how many indicators should I use? If you're still new to trading, I would suggest you to use one indicator first. Okay, for example, simple moving average. Learn how to identify uptrend and downtrend first. So once you're proficient in it, you can add moving average. Once you are better, you can add another, let's say, RSI. Okay, I believe these three indicators is good enough. All right. So I'm sorry because time limitation. So it's time for me to conclude today's webinar session. Now, once again, please take a moment. For those of you, if you have missed out the announcement earlier, I would like to share with you that our upcoming Let's Learn Futures webinar series. Now, this LIF webinar series has a variety of topics scheduled every Tuesday evening, same time from 8:30 to 10 p.m. because we cover a wide range of content-packed and informative topics where you can gain practical knowledge about futures trading from our experienced speakers. And of course, if you are interested in any of these sessions, please scan this QR code or click onto the link in your chat box to register them. And also, you can go to our website. You can find an event calendar. You just need to find Tuesday column. So you can click on the Tuesday event and register yourself accordingly. Besides that, we have an online workshop. As this additional online workshop is actually tailored for those of you who are new to futures market. So of course, if you're new in futures trading, or for those of you if you are participating this DVTC Derivative Virtual Trading Challenge, then this online workshop is definitely ideal for you. You can take a picture or screenshot this page and register yourself after this webinar ends. And feel free to share this event to your friends and family who are also interested in futures trading, because in this workshop, we will guide you hand in hand on how to start your first futures contract. It's entirely free and sponsored by Bursa Malaysia. And of course, please note that each session is limited to 50 online attendees only. So be sure to register yourself quickly to secure your seats in both workshops. You can also find this in our event calendar on Saturday column itself. Okay, it's actually a full day workshop from 9:30 to 12, workshop 1, and workshop 2 would be 2 p.m. to 5 p.m. Besides that, currently, Bursa Malaysia is currently running the DVTC, the Derivative Virtual Trading Challenge 2025. If you're interested to join, you can still register yourself. It's a virtual trading where you can take this opportunity to gain hands-on experience in trading derivatives and also compete with others nationwide. So it's an interesting event that you can also improve your trading. All right, so we have come to the end of our webinar session for today. And to all of you who joined us, thank you for your participation. And I hope that you find this webinar both informative and valuable, although time limitation, I wish to share more example with you. And I believe you have gained some knowledge and perspective on how you can combine price action trading strategies and technical indicators to improve your trades. And of course, most importantly, there are criteria for you to combine them as well. Okay, do take note of the criteria. All right, so with that, I'm CY signing off for now, and enjoy the rest of your day. Have a good evening, and until next time, bye.